The balance sheet as a treasure map, why Peter Lynch focuses on 13 key signals. Peter Lynch is celebrated as one of the greatest investors in history not because he had magical insights or complex formulas, but because he had the ability to see what others ignored. While most investors get lost in hype, fear, and noise, Lynch always returned to what truly matters, the fundamentals of a business. And there is no better place to measure the real health and potential of a company than its balance sheet. Lynch's approach is refreshing because he doesn't view financial statements as boring documents written only for accountants. Instead, he sees them as treasure maps filled with clues about future winners and silent warnings about dangerous companies. A balance sheet tells a story about how responsibly a company grows, how it handles debt, how wisely it allocates capital, and how prepared it is to withstand crisis. Lynch believed that if you want to invest like a detective instead of a gambler, you need to read the clues hidden inside the numbers. Before we explore the 13 balance sheet signals Lynch emphasized, we must first understand his mindset. Lynch wasn't looking for perfection. He wasn't searching for the most glamorous stocks. He wanted understandable businesses with strong fundamentals that could continue growing year after year. Many investors fall into the trap of judging companies by flashy narratives, promises of disruption, futuristic technologies, or charismatic CEOs. Lynch warns us, hype can fool the crowd, but the balance sheet doesn't lie. One of Lynch's essential rules is that a company must be able to survive tough times without begging for money. When a business is drowning in debt, even small disruptions can turn a promising story into bankruptcy. But if a company is financially strong, market downturns become opportunities, it can grow while competitors struggle. This is why Lynch starts with assets versus liabilities. If a company does not have enough financial strength to weather storms, he simply moves on. No drama. No emotion. The first thing he checks is how much cash the company has on hand. Cash is like oxygen, it keeps the business alive when revenue slows down. Companies with high cash reserves have flexibility. They can invest, acquire, innovate, and recover. Meanwhile, companies with no cash and high debt are like swimmers with ankle weights. If the sea gets rough, they sink fast. Lynch often bought companies when Wall Street was blind to their strength. He mastered the art of finding undervalued winners by examining tangible fundamentals that others overlooked. If debt levels were low, assets were strong, and growth was consistent, Lynch saw opportunity, even if the stock price was temporarily depressed. And that's the second major point: price doesn't define value. A strong balance sheet gives you confidence that the business underneath the stock is durable, reliable, and capable of compounding wealth over time. Lynch also paid close attention to inventory. If inventory rises faster than sales, that's a red flag. It means the company might be overproducing, demand may be slowing, or financial trouble is brewing. Conversely, efficient inventory turnover signals product demand and operational excellence. Another core belief: revenue means nothing without profitability. A company may appear successful on the surface, growing customers, opening stores, launching products. But if profits aren't rising along with the business, something is broken. Lynch loves companies that know how to convert growth into real earnings. That's where return on equity, ROE, and return on assets, ROE, come in. High returns indicate smart management and competitive advantage. Every number in the balance sheet is a puzzle piece that reveals how well the company runs its business. And when those pieces fit together correctly, you have the foundation of a long-term compounder, the exact type of company that made Lynch's portfolio legendary. Lynch's philosophy is built on simplicity: invest in understandable companies with solid balance sheets and bright futures. Yet simplicity does not mean naivety. Lynch is sharp, analytical, and always alert for warning signs. Bad balance sheets often hide behind exciting stories. Good balance sheets often hide behind boring businesses. Lynch famously said that the best stocks are often dull companies with dull names doing dull things, but doing them extremely well and profitably. In his balance sheet analysis, Lynch looks for discipline. How wisely does the company use its money? Is management acting like owners? Are they focused on building real value or chasing risky expansion? Nothing exposes poor decision-making like debt-fueled growth. Nothing signals strength like growth funded by profits. Lynch does not fall in love with stories. He falls in love with numbers that prove durability. He is the champion of common sense investing, buying businesses that can survive bad times and thrive in good ones. As we move forward in this documentary, we will break down the 13 powerful balance sheet signals Peter Lynch uses to distinguish future winners from inevitable disasters. These signals are not complicated. They are practical. They are logical. And they can dramatically increase your success as an investor. Lynch's message is simple: if you learn to read balance sheets correctly, you will see what the market is too impatient, too emotional, or too distracted to notice. The balance sheet is not just financial data, it is the heartbeat of a company. And Peter Lynch shows us exactly how to listen. In the next part of our journey, we'll reveal the first half of Lynch's 13 crucial balance sheet signals, what they are, why they matter, and how you can apply them to become a smarter investor starting right now. Peter Lynch believed that numbers tell a story, but only if the investor knows how to read between the lines. The balance sheet is not just a list of assets and liabilities, it is the company's autobiography, its past choices, current strength, and future capability. In this part of our journey into Lynch's financial wisdom, we dive deeper into the 13 key signals investors must look for. These signals help separate the financially healthy from those on the brink of collapse. Lynch always emphasized, if you avoid the companies with broken balance sheets, you've already improved your odds. Let's start with the first red flag, ballooning debt. Lynch warned that high debt turns small setbacks into existential threats. A business with too much leverage is like a ship full of holes. Calm waters may hide the problem, but the storm will always reveal the truth. The crucial metric: the debt-to-equity ratio. If debt grows faster than earnings or equity, investors must take notice. He famously stayed away from firms that depended on borrowing to survive another quarter. The next signal is shrinking working capital. Companies need enough short-term assets, cash, receivables, inventory, to pay their short-term obligations. Lynch argued that when working capital dries up, management begins to take desperate actions. They delay supplier payments, cut essential spending, or issue new shares just to stay alive. That leads us to the sustainability of inventory. For a retailer or manufacturer, inventory is lifeblood. But Lynch warned investors, if inventory piles up faster than sales, trouble is brewing. It means customers are not buying what the company makes. Lynch called this the rusting warehouse effect. Products rotting in storage symbolize declining demand. Next comes the quality of receivables. It's one thing to sell products, it's another to collect cash. Lynch urged investors to track accounts receivable closely. If receivables rise faster than revenue, the company might be booking fake growth, sales made to customers who might never pay. Sales are vanity, cash is sanity, he would remind investors. Then there's asset write-downs, companies suddenly admitting they overpaid for acquisitions or investments. Lynch believed frequent write-downs signal poor judgment at the management level. If leaders consistently make bad bets, why should shareholders trust them with more money? Tangible assets versus intangible promises was another crucial filter. Lynch was not against intangibles, but he cautioned investors to differentiate between intellectual property that generates revenue and goodwill that only exists because a company overpaid in the past. The balance sheet should reflect real value, not wishful thinking. A related signal is the cash position. Lynch loved companies with strong war chests. He admired those that could fund their expansion, survive recessions, and seize opportunities without asking bankers for permission. Cash gives management freedom, a lack of cash leaves them powerless. But Lynch also warned about lazy cash, excess funds that sit idle instead of generating returns. Healthy companies find a balance. Profitability metrics also matter. Lynch liked businesses with consistently high return on equity and return on assets. These show how efficiently management turns investments into profits. A company that makes average returns while holding exceptional assets might be poorly run. Then, we look at share dilution. Lynch paid careful attention when companies issued new shares. If they dilute shareholders regularly, it means they rely too heavily on the market for funding. Investors must ask, is management enriching itself while shareholders get crumbs? Another warning sign, pension obligations. Many companies promise more retirement benefits than they can realistically pay. Lynch compared this to writing checks on future income that may never come. A pension deficit can become an invisible anchor pulling the entire business downward. Contingent liabilities, lawsuits, regulatory risks, environmental penalties, also demand scrutiny. Lynch believed that hidden dangers often reveal themselves at the worst possible moment. Smart investors must anticipate the threats buried deep in the footnotes. Finally, the trend of retained earnings. Lynch said a company that reinvests profits wisely becomes stronger over time. But if retained earnings grow while the stock price goes nowhere, it means the reinvestment strategy is failing. He urged investors to ask, how is the company using its profits? Are they creating shareholder value or wasting capital on mediocre projects? Ultimately, Lynch's 13 signals share one common purpose: to protect the investor from stepping into traps disguised as opportunities. He didn't expect perfection in every category, but he demanded strength in enough of them to justify confidence. Lynch always stressed the moral at the heart of this analysis: when you invest, you are partnering with a business. Would you willingly partner with someone drowning in debt, hiding risks, and making poor decisions? The balance sheet reveals character. It exposes discipline or carelessness. It highlights transparency or deception. That is why Lynch looked at the numbers not as static figures but as behavioral clues. Investors who master this mindset stop chasing hype. Instead, they focus on real financial power, the kind that endures bear markets, recessions, and global shocks. In the world Lynch teaches us to navigate, the winners quietly compound wealth while the weak collapse under the weight of their own financial mistakes. His 13 balance sheet signals are not just guidelines, they are a survival toolkit. Peter Lynch believed that the true magic of investing lies in avoiding disasters rather than finding perfection. In Part 1 and Part 2, we explored the structural pillars of the balance sheet: debt levels, working capital, inventory risks, cash reserves, shareholder dilution, and hidden liabilities. But Lynch's philosophy is not only about detecting threats, it is also about identifying the opportunities that others overlook. A strong balance sheet is not just a shield, it is a weapon companies use to accelerate growth. Lynch frequently reminded investors that the market eventually rewards financial discipline. When the economy tightens, companies with sturdy foundations can expand while fragile competitors shrink or disappear. Think of it like a forest fire. The weak trees burn to ash, while the strongest survive and gain new space to grow. Lynch loved hunting for those survivors, companies with fortress-like financials that outlive every crisis. One of Lynch's most fascinating ideas is the concept of built-in resilience. A company with manageable debt, high returns on assets, rising retained earnings, and consistent profit margins has the internal engine to keep moving forward regardless of external noise. It does not need miracles. It does not wait for interest rates to fall or sales to suddenly skyrocket. It steadily improves year after year. Lynch warned investors to avoid companies lacking this resilience. You don't want to own a business that collapses the moment the economy sneezes. A durable balance sheet signals endurance, adaptability, and long-term competitiveness. Lynch often compared investing to flying a plane. You can enjoy smooth skies for hours, but you judge the quality of the aircraft when the storm hits. The same is true in finance. When recessions hit, bad balance sheets become death sentences. Strong ones become springboards. Another crucial piece in Lynch's balance sheet analysis was the quality of management. Numbers don't exist independently, they are the product of human decisions. A brilliant management team can take an average company and turn it into a compounding machine. A reckless or egotistical management team can destroy a golden business in a matter of years. Lynch insisted on reading annual reports not to see what happened, but to understand who made it happen. If executives rewarded themselves while the company struggled, that was an immediate red flag. If they constantly issued new shares, borrowed excessively, or bought other companies at insane prices, shareholders should worry. Lynch preferred humble leaders with a large personal stake in the business, because people take better care of what they own. He joked that a CEO who owns no shares is like a captain who refuses to board his own ship. The long-term investor must trust both the financial structure and the people behind it. Lynch highlighted a powerful principle: a company with a strong balance sheet can afford to make mistakes. Business is unpredictable, even great companies stumble. What matters is whether they have the financial cushion to recover. Companies drowning in debt have zero room for error. Even a small downturn becomes fatal. Lynch had a name for these ticking time bombs: corporate trapeze acts. One slip, and they fall. To protect yourself, he advised, choose firms that run with a safety net. He also explored what he called the snowball effect of financial strength. When a company reinvests profits into high-return projects, growth compounds exponentially. Strong finances generate more strong finances. It becomes a chain reaction that builds shareholder wealth quietly, invisibly, year after year. The opposite is also true: financial weaknesses compound into larger weaknesses. High debt leads to higher interest payments, which lead to margin pressure, which leads to layoffs or asset sales, which lead to shrinking market presence. Eventually, the business loses relevance. Lynch wanted investors to catch this downward spiral early, before the market wakes up to the danger. Another key advantage of balance sheet mastery is emotional stability. Investors who understand financial fundamentals don't panic when stock prices fluctuate. They know what they own. When markets crash and fear dominates the headlines, Lynch-style investors buy more of strong businesses at discounted prices. While others run away, they seize opportunities. This level of calmness only comes when you have a clear picture of financial strength. Lynch proved that investing is not a gamble, it is a discipline. It is the practice of matching rational analysis with long-term patience. The balance sheet is the foundation of that discipline. Without it, the investor is blind. Lynch encouraged investors to embrace simplicity. You don't need complicated derivatives, macroeconomic forecasts, or crystal balls. You need companies that earn real money, spend wisely, and maintain financial control. He once said, "Stocks are not lottery tickets. They are ownership claims on real businesses. If the business thrives, the stock will eventually follow." No hype can override poor financials for long, and no panic can suppress strong financials forever. The market may misprice companies in the short term, but in the long term it becomes a weighing machine. It weighs profitability, stability, and survival. Lynch's 13 balance sheet signals are what keep you from holding companies that get crushed on that scale. The ultimate lesson: before falling in love with a company's story, brand, or product, fall in love with its numbers. The balance sheet is where the truth lives. It does not lie, it does not exaggerate, and it does not rely on market optimism. Lynch's advice is clear: protect your money first. Look for strength, reject fragility, and let the compounding engine of financially disciplined businesses work for you. This is how ordinary investors, teachers, workers, everyday savers have turned small amounts into life-changing wealth following his philosophy. A strong balance sheet is the investor's greatest ally. And once you master the art of reading it, you unlock the power to confidently build wealth for decades, not days.